Back, everybody. We are now in chapter 22, which is the helping section of the book. And this is a lesson all about angel investing. I'm proud to be wearing Convey's t-shirt today. Convey is led by Rob Taylor, who's an exceptional entrepreneur, and we're very proud to be involved. And believe it or not, this past week, we just committed to our 101st startup investment, an amazing company that you'll be hearing all about named Prima, which I think will really popularize in a very high profile way the CBD movement, especially with a co-founder who was the co-founder of the Honest company before. So really exciting times on the investment front. And I'm really happy to be delving into this chapter with you. I think you'll find a lot of entrepreneurial wisdom in this chapter too, if you learn how an investor actually thinks about assessing startup investments. So here we go. Chapter 22, 7 critical lessons learned in angel investing. I decided to include this lesson in the book for 2 reasons. 1, if you become a successful entrepreneur, you may feel like it is your duty to give back to other entrepreneurs, honoring those that have helped you along in your journey. 2, as an entrepreneur, it is helpful for you to learn how angel investors think, as they're increasingly becoming the primary source of seed stage capital as the early stage VC funds move further upstream to the Series A stage. I had dinner with my good friend and Bizarre Voice co-founder Brent Barden on Tuesday at the New Sway in Westlake Hills, which I linked to here on Medium. Yummy. And we talked about lessons learned in angel investing. It was on my mind as I'm doing an AMA, an Ask Me Anything webinar with my good friend and often investing colleague Josh Baer on Tuesday, February 5th from 4 to 5 p.m. Central. You can sign up here. During my conversation with Brent, I distilled down to 7 lessons learned, in the spirit of Lucky 7, of course, and I linked to my blog here on Medium. Brent is reading Jason Calacanis' book on angel investing, which I linked to here on Medium, and told me that many of these lessons are in there. Maybe all of these. I haven't read the book. So you may want to tune into that to really dig in, as I'm going to do my best to keep this lesson short. My hope in sharing these with you is that it ignites more angel investing in Austin and beyond. It is vital to our startup ecosystem here. We're doing better on that front in Austin than ever before, but I believe we're only scratching the surface here, and I hope these lessons have an impact beyond Austin startups and angel investors. These 7 lessons are distilled from angel investing since 2010. We are in 62 startups and 19 VC funds now, and I link to our portfolio here. An editor's note, we're now in 101 startups and 31 VC funds. And I have some good data at this point on how profitable our endeavors have been. So I feel pretty qualified to share these lessons with you. Outside of the scope of this lesson is what is on my mind when I actually meet with an entrepreneur to assess their startup. And I've looked at this point, over 2,000 startups since 2010. Read chapter 19, the 5 critical ingredients to build a big company, for more on that. Okay, without further delay, here are the 7 lessons learned. Number 1, the number 1 mistake I've seen new angel investors make is that they invest in too few startups with too much capital in each. I've limited our net worth in startup investing to around 5% of our wealth. Very few angel investors I've met are that disciplined, as greed can get the best of you. The beta risk is high as many startups go bankrupt, and what you're looking for is the few that will generate a large enough return to make your efforts worthwhile. Others have made this observation, including Tucker Max in Austin. You can read his thoughts in this post, and I link to that here on Medium. Mike Maples Jr. of Floodgate has written about the power law dynamic in VC startup investing, and I encourage you to become educated on it. I link to his post on that here on Medium. To put this in practice directly, if you have $1 million to invest, you're much better off putting $25,000 to $50,000 in each startup than $100,000 to $200,000. Austin needs you to stay in the game and learn it well enough where you can see, like Jason Kalkanis has, or Deborah and I have, that it can be a very profitable endeavor. Too many angel investors try it with just a few startups, don't get good returns, and conclude that they are awful angel investors. The reality is that they didn't give themselves a real opportunity to learn the craft. I'm a big fan of Jerry Newman's post, and here is a great read on this lesson, and I link to that here on Medium. Number 2, you're better off investing in what you know. For me, this is software as a service. Half of our startups are SaaS. You'll be able to help these companies better as a mentor. It doesn't mean you won't be able to help other companies, and we are in many B2C startups, for example. Often, your mentoring will be focused on topics like how to raise money and making connections for the startup CEO, how to recruit, how to manage your board and investor relationships, how to sell, and so on. These are applicable to all sectors of startups, but you'll have better pattern recognition and therefore likely better outcomes in the sector you know best. Mark Cuban has made this point, I've heard, and read in an article a while back, but it should be obvious to you overall. Number 3, on average, we have generated far better returns from serial entrepreneurs than first-time entrepreneurs. Michael Dell, Mark Zuckerberg, and Bill Gates were first-time entrepreneurs, I guess. I say I guess because I know Michael was very entrepreneurial even prior to Dell. So you may question this logic by thinking, I'll miss out on the best if I don't take that risk on the first-time entrepreneur kid genius. Maybe that's right. But there are many, many more examples of successful entrepreneurs that are repeat. For example, Reid Hoffman in LinkedIn, Reed Hastings in Netflix, Anil Bushri in Workday, John Mackey in Whole Foods, and I could go on and on and on. It is true that some young entrepreneurs have otherworldly wisdom, but most of us, including myself, build that entrepreneurial wisdom over time. I'm on my 6th startup at Data.World. With my 5th startup, Bizarre Voice, our initial investors generated a 70 to 110 times their money return. Imagine that. If they had invested $100,000, they generated up to $11 million if they held on to the peak of our stock price. Some of our most exciting angel investments in Austin are led by serial entrepreneurs and include startups like Alert Media, which just had a huge exit this week, Dosh, Dropoff, Clearblade, Infinite.io, Convey, Rollick, Smarter Sorting, Pingboard, Zen Business, Rocket Dollar, and others. This is certainly not meant to be a comprehensive list for us and excludes some in our portfolio founded by first-time entrepreneurs that are really exciting, such as Julia Taylor Cheeks Everlywell, which I mentioned to you at the beginning of this, raised at a $1.3 billion valuation recently. Number 4, if you have a company performing really well, make sure you invest in their next round, at least your pro rata amount. Momentum begets momentum. VC funds usually reserve 30 to 50% of their fund's capital for follow-on rounds. In general, we invest in seed, Series A, and sometimes Series B rounds, and sometimes in all 3 for a single company when things are going well. Although investing early means taking more beta risk, you have a much higher alpha upside if it really hits. Number 5, we invest in VC funds when it serves to diversify our startup portfolio in the hands of proven experts. This is why we're investors in both CAVU funds, that's CAVU, and I link to those here on Medium. We are not CPG experts, but we're fortunate enough to be angel investors in Deep Eddy Vodka, led by our good friend Clayton Christopher, who, by the way, was a serial entrepreneur, having led Sweet Leaf Tea before. See lesson 3 above. When Clayton decided to start a fund after his incredible sale of Deep Eddy Vodka, we knew we had to be investors. We already believed in the macro trends of niche brands, retail differentiation, and disruption in the age of e-commerce, the long tail, and I link to that book here on Medium, and consumer taste and diets shifting faster than big CPG companies could keep up with. In all things being equal, capital being capital, we thought that entrepreneurs would want to work with CAVU to get experienced guides for their journey, proven CPG experts who understood shelf placement, branding, market research, and so on. Likewise, we invested in multi-coin capital because we personally don't specialize in cryptocurrency or blockchain. And we invested in Forerunner Ventures because they understand B2C and serve a different geography, and others. In general, this means we're primarily in SaaS and in Austin startups as direct investors and leave expert VCs for the rest, diverse industries and geographies. Number 6, if you can really help the company, offer to serve on their advisory board for common equity in addition to your preferred equity investment. This has worked out very well for us and allows us to help the company even more directly. For the hit companies in your portfolio, you'll make money on both the preferred and common equity this way. The entrepreneurs are very interested in protecting their common and maximizing the value of it. So you're aligned with them as an advisory board member on maximizing its value. If the company is early enough in its history and the stock value is very low, such as it is at a company's founding before it raises any money, then you should see if founders are doing an 83B election, and I link to the rules for that here on Medium, and whether or not you can participate as well as an advisory board member. Note that you have an advantage as compared to venture capitalists and that they cannot earn equity this way. It is unique to the angel investing model. VCs don't get additional equity for serving on your board of directors or being an advisor to your company, as it is expected from their LPs, and they need to share in the standard 80-20 model. As an entrepreneur, I practice what I preach here. Look at all of the amazing advisory board members we have at Data.World, 65 and counting, and I link to that here on Medium. Also note, if the company becomes a fight for preferred over common, in almost all cases, no one is going to make a lot of money and is not a great outcome overall for anyone. Entrepreneurs have to do well for investors to do well, generally speaking. And as it should be, they are doing the real work every day. That is why I almost never invest in a company that is early stage and already has a big board of directors of angel investors that already control the majority of the equity with little to no VC involvement. That is a clear sign of the entrepreneur being micromanaged and not very incentivized, and it is usually a sign that those investors are playing for a conservative base hit instead of swinging for a home run outcome. Number 7, don't just trust your own instincts. Make introductions. Building a network is a very valuable activity for you as both an entrepreneur and investor. When I meet a new entrepreneur that I really like, I make a lot of introductions to potential investors and advisors. This is not just easy to do. It is really valuable for the entrepreneur as well as us as the potential investors. I get market intelligence from people that I know can really help. and they get to see the deals that I'm looking at. Plus, it incentivizes them to do the same. Show me their deals. This activity also bonds you to the entrepreneur. They genuinely appreciate it and know the value of a warm versus cold introduction. When you are just becoming an angel investor, go out there and start selflessly serving the community. Karma will inevitably kick in. Become a mentor at Capital Factory, Techstars, and Skew. And I link to all three of these on Medium here in Austin, and other places that are known for helping entrepreneurs. This will ultimately help you build a network rapidly. Note, if you hold your stock in a startup for at least 5 years before selling, you could also have a very favorable capital gains exemption. I encourage you to get familiar with Section 1202 of the Internal Revenue Code, and I link to that here on Medium. This is, of course, a U.S. law. I hope all of these lessons help you become a first-time angel investor, or a more successful one if you're already doing it. We feel truly fortunate to work with the entrepreneurs that we do. It keeps us young, and it is one of the inputs that led to me starting my sixth business in Data.World. I was genuinely inspired by them. I would love to hear your own lessons learned in the comments. I'm certainly under no illusion that this is a complete list, and I'm always learning, a nod to Chapter 4. And I include our logo here at the end on Hurt Family Investments, which I proudly run with my wife, Deborah.